Dear students, how are you? Hope all are at home and doing your study nicely. So, in last class, we know about direct write-off method of recording accounts receivable. Today, we'll discuss allowance method of recording account receivable. So, we know that all the nominal account, that is income and expenditure accounts, are abolished in the same year, and no balance for that is carried for another year. Rather, it is transferred to income statement and only the net profit or net loss is carried. So, in this way, if we do credit sales and sales is shown in the income side and the receivable from credit sales are not received in the same year, and in the next year if some portion of that receivable could not realize, then that loss will affect next year, not in this year. To solve this problem, the system allowance method is introduced. This is more applicable and this is more practiced method. So in this method, what we'll do, we'll just create an allowance for bad debt every year in the same year, because we don't know which debtors will not pay. So we cannot reduce the accounts receivable, particularly from whom we'll get the money. So we'll introduce allowance for that, and we'll just assume with our past experience and future commitment, we'll assume how much in the next year we may not get. Accordingly, authority will decide, and according to the decision, we'll create some allowance, and actual how much we are not getting, that will be adjusted with this allowance. So to record this method, what we'll do, when we'll find some bad debt, that is money we become sure that we'll not get, to write off that money, we'll do the journal, that is provision for bad debt debit, and accounts receivable will be credited. I think you understood. I'm giving the example from your book. This is page 614. You can see from your book here. See the first journal for bad debt written off. This is provision for bad debt account debit and accounts receivable account credit. So this is actually how much we didn't get. To write off that amount, we adjust it with the old provision. Now for next year again, we'll take the precaution and we'll create some allowance. So to create new provision, how we'll record it, we'll give the journal entry bad debt expense debit and provision for doubtful debt credits. This is to create new provision for bad debt, and after that the total summary will be transferred to the income statement, and when we'll do that, income statement will be debit and bad debt expense will be credit. Sometimes if we find that bad debt plus new bad debt plus a new bad debt provision become more than old provision, if it will be like so. But if old provision is more than bad debt new bad debt plus new provision, the journal will be otherwise. That times our income statement will be credited and bad debt expense will be debited. So now let us solve one question. Okay, so this is page 636, practical example 5. Look at the question. Here, account receivable given 1st January 2012, then provision for bad debt is given, that is old provision, then credit sales is mentioned here, then bad debt, this is new bad debt, and bad debt recovered in 2012, also another new clause came. We'll see how it is solved. Then direction came, create 5% provision for bad debt on the accounts receivable at the end of the year. So we'll solve it. Let us see the calculation first. See, accounts receivable is given 60,000. Then this year there was credit sales for 1,03,000. So earlier accounts receivable plus new credit sales, total accounts receivable become 1,63,000. From this we have to less the new bad debt. So new bad debt was 3,000. We deducted 8, we got 1,60,000. So on this 1,60,000, we'll calculate 5% provision for bad debt. So it become 8,000. This 8,000 is our new provision for bad debt. So to create this new provision for bad debt, we have to do another calculation. The calculation is very easy, you know it. That is, we'll write first bad debt, then new provision for bad debt will be added with this, then we'll deduct old provision for bad debt. So with that 5,000 to be transferred to the income statement, but as we recovered 2,000 this year, it should be also deducted, and finally the loss become 2,000 less, and now the final loss is 3,000. This 3,000 will be transferred to income statement. Let us see the journal entries. For credit sales, you know, account receivable will be debit here and sales account will be credited. Now when it is recorded, now we will go to record the bad debt. To record bad debt, that is to write off bad debt, the journal will be provision for bad debt, it will be 3,000. See, it is 3,000, and account receivable is credited here for 3,000. Now we'll go for a reversal entry. As we received 2,000 earlier, we recorded some bad debt that it is not recoverable, but finally we could able to receive that, so we'll give a reversal entry for that. For that way we gave this journal entry, that is accounts receivable debit and provision for bad debt credit. When we created new bad debt, that times we are giving journal entry for provision for bad debt debit and account receivable credit. As we are getting this money, we got this money, so first we need to give a reverse entry. For that way we have given this entry, that is accounts receivable debit and provision for bad debt credit. Now we'll receive the money, that is it is received in cash, so cash account debit and accounts receivable credited. As it was mentioned 2,000, we recorded 2,000. Now we'll go for finally income statement. The necessary amount will be transferred to provision for bad debt. That bad debt expense is debit and provision for bad debt credited is 3,000. What the calculation was done here, finally see it is 3,000. That 3,000 is transferred here. So, and this will be now total bad debt expense will be transferred to income statement. So see, income statement become debit and bad debt become credit 3,000. I'm telling the last journal again. When new provision for bad debt was created, for that why we did this journal, bad debt expense debit and provision for bad debt credit, and it is 3,000. The same amount will be transferred to income statement, and it is our loss. For that why income statement become debit for 3,000 and bad debt become credit for 3,000. Now I hope from this journal you can do all the ledger and how it will be shown in the income statement, as well as how it will be shown in the position of financial statement. So thank you very much. Try this solution, that is practical example 5 at your home, and if you don't understand anything, please don't hesitate to contact with me. Thank you. Stay at home.